The Taiwanese index is flat, is trading with a positive bias.
The 40-day exponential, which is 22,311.
Adjusted EBITDA came in higher by close to 28%.
So the sensex, which is starting at about 73,991.
As of now, the extended time frame is shell.
So in terms of household insecticides, we remain quite bullish.
10 other seats going to polls today, all of them important, be it ETA, be it Badayu.
Brokers are divided and they feel that the times are not right probably for extended hours.
I think we are much better placed to deliver double-digit revenue growth next year.
Business was pretty much in line with what we had expected.
In fact, now since Friday is when you started seeing the selling pressure emerge.
Well, that's the day so far. You're with us here, a new edition of Closing Bell, last hour coming up, and it's been quite a sort of down, up and down again kind of a day, but mostly down. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Surabhi here. Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon. Day 3 of selling pressure.
Well, I love the fact that the men are flashing a little bit of pink, but the market is not in much of pink. I think it's all in my shades for not for this afternoon, the last couple of days, I guess.
No, absolutely, and I think we'll see. We were talking about this in the morning that maybe it's not the global stuff which is bothering the markets or anything of that sort. Globally, if anything, starting last Friday, we should have had almost like a fresh leg up because yields are down and dollar is down and equities are up. So it's none of that. It's local, and maybe elections at the margin, perhaps in the market's mind. More than usual. So we're at about 22,257. Let me just quickly take a look at a few points before we sort of move forward. So we're off the lows, but as we speak, it's fluid. We're sort of selling off again. So there is pressure. Nifty is trading around, and this was about 8 minutes back, we were trading around the 40-day exponential moving average, which was about 22,311 or so. So from that point even, we've come off a little bit. But the 40-day is that. You get a firm close, and we look like we are on track for that. Then you're looking at lower levels. You're looking at, 22,166 levels, which is another 100 points down. What is that? That's a 61.8% retracement of the last leg up. So that is 22,166. That's the first level after a break of the 20, and of course, if we close below the 40 as well. Bank Nifty is interesting. It's down 1% the last I looked, but that is 1.25% now. But it is not broken below the previous low of 48,088. That's last Thursday's low. Here the 20-day comes in at 48,416, which is, I think, gone now with that extra 0.25% cut since the last time I looked at these rates. Here again, you'll have to start to look at retracements, etc. So last 60 minutes, crucial. Will the selling accelerate, or maybe we find some semblance of support? Real estate, metals and pharma. These are three areas where stocks are seeing the most pronounced selling. Rima.
There is a bit of sector rotation taking place away from PSUs. And back into the FMCG names. So if you look at the PSU index, it's down 5% in the last 2 trading sessions. Banks in particular, the PSU banks, have been under pressure for 4 consecutive days. And in those 4 days, we've lost close to about 6.5%. So maybe there is some money moving out of these outperforming PSU names into the FMCG sector, which has been an underperformer and is also underinvested. Compared to the rest. So the FMCG index year to date is up 15.5%, while the Nifty is up 24%. And there are names like HUL, which have actually recorded a decline in the last 1 year. So money is moving back. Look at the way you've seen names like Marico, GCPL, Dabur. HUL itself is up close to about 5%. So big moves. Marico was up 9.5%. The low today was 22,232. So we're still about 50 points away from that level.
Absolutely. Well, yeah. So once again, barring FMCG, it's a very broad sort of a sell-down, sell-off that we're in the midst of. And the problem is that we're consistently underperforming a lot of global markets. Now, you can argue that in April it was reverse. India was outperforming Wall Street. Maybe some of that outperformance is simply getting set back. But I just thought I'll put the numbers on the table for what it's worth. 5 trading sessions in May so far. That's our picture, down between 1 to 2.5%, depending on which index you're looking at. Wall Street is actually up, and the Nasdaq's been roaring away. There's no stopping that rally on the Nasdaq. 4% higher already so far in the 4 or 5 sessions that we've had. The Dow's done really well, and that whole thought process of the rate cut expectation perhaps still very much on the table. So that's Wall Street. Even Asian markets, if you look at our neighborhood, then the Japanese market, which has moved on steroids in the last couple of months, that's continued. Hong Kong picked up. Kospi's done okay. So basically, India has been a rank underperformer so far. Let's see if that changes or not. A lot of speculation in the market with respect to today. I just want to put that on the table. It's all speculation. Not sure if it really adds up. There's some chatter about mutual fund data. We'll have, by the way, the official mutual fund monthly numbers on Thursday. And remember, April was the month when the new KYC norms kicked in, and it seems that there's some hiccups with respect to that. So could that lead to lower flows? I mean, this is all conjecture, theories that are doing the rounds in the market. But the fact is that there are jitters, and perhaps more of it related to elections more than anything else. But Nigel, I know you are looking at the VIX and this big surge in the VIX that we've seen in the last 24 odd hours. And I know you're looking at historical patterns as well. So is this a reason to worry? Or are there parallels with 2019, the previous general election?
Well, that's right. The India VIX is at a 52-week high. But the question is it a worry? Or are we just seeing a repeat of 2019? Now, from the recent lows in April, the India VIX has gained 70%. And the Nifty has pulled back approximately close to around 500 points odd. And so this appears to be a repeat of 2019. At that point of time, the India VIX has surged by close to around 50% between April to May. And the Nifty had dropped by close to around 500 points. But post the election verdict, well, you had the VIX that collapsed. Just take a look at those numbers on the screen. And the Nifty rallied close to around 800 points odd. Now the VIX has seen a massive surge from a 52-week low to around a 52-week high. So the India VIX is surging. Well, it's not yet a reason to panic. And one should not link this rise with an expectation of any massive correction. But it definitely should mean sharp moves intraday on either side in the next coming few sessions. So some bit of caution on the table. Now, in the run-up to the big event, one should avoid any kind of naked option writing because you can get whipsawed, and also manage your leverage positions with efficient hedging of positions, as well as maintaining some kind of stop losses, just in case the trade or the view that you're taking goes wrong. So be prepared for whipsaw moves with drifts for the next few sessions. But as of now, this surge in the India VIX, it appears to more likely to be a repeat of 2019, when we saw a surge in the India VIX ahead of the elections, with the Nifty dropping. And post the verdict, which was favorable from a market perspective, the Nifty conquered those levels that we saw prior to the fall, and the India VIX corrected to the levels that we saw prior to the rise out there. So no need to worry as yet. It appears par for the course as of now. Well, how do you position yourself though in the final hour of trade? Mitesh Thakkar joins us to help us out with some closing strategies. Hi, Mitesh. Good afternoon. Well, the markets are seeing some kind of selling at higher levels. We're holding around this 22,250. We've got a Nifty Financial Services Index that plays out expiry as well. What's your view?
Yeah. I think, one, the market is lacking strength to give a decisive breakout on the higher side. We were there on Friday as well, and we sold off from those levels of 22,757. But it isn't looking like a very big structural weakness kind of coming into the market. So my understanding is that this would call for, if nothing else, on the minimum, some kind of a consolidation which could happen. And therefore, I would watch the levels of 22,200, 250 zones very closely. I think that's where the key supports kick in. So it's still about 100 points lower. In fact, the intraday low is 22,232. So around those levels, you will see some support. Only if you see a closing below this 22,200 zone, then I would slightly worry. But then it looks like a market which might see some kind of idle activity with 22,200, 13,220 coming in as the lower end of the range, and 22,700, 750 coming at the upper end of the range. On the soft side, I have a cat stock on the buy list. That's Phenolics Pipes, making a fresh high after about 8 sideways consolidation. So it's a good pattern breakout. Buy here the stop at 273. Look for a target of around 295 to about 300 in the short term. And on the stock side, I have a sell on SRF with a stop at about 2465 for targets of 2370.
Okay, we'll get to the FMCG sector and get in Mehraboon's view also on it. But before that, Mitesh, any thoughts on HUL or Dabur, GCPL? Big breakout visible? Okay, we've snapped that connection with, Mitesh. We'll get back to him. We've got Mehraboon Irani with us on the show. Mehraboon, afternoon, and thank you very much for joining in. We'll get Mangalam to talk about the FMCG sector and, what's driving these stocks higher, what's leading to the buoyancy and what they've said, the numbers which are out. And today you have Pidilite and UBL reporting numbers. But is there a preferred, stock in the consumer staples? Do you think consumer staples have made a comeback? And is this a tactical up move, just perhaps till, pre-election, a little bit of a monsoon, good monsoon expectation? Or do you think now the buoyancy in, consumer staples is here to stay?
I think the way you address this question, I think if you give me a minute and a half, I would possibly like to address it in the right way, and I will touch upon FMCG also. So we need to understand that the backdrop of this Indian markets right now, where caution has come in, people are becoming a little bit apprehensive. The point is the world markets have been very supportive. The geopolitical problems, which were just less than 3 weeks ago, have suddenly eased for now. Market has digested the fact that rate cuts in the US are not going to come in a hurry. The US markets are doing very well. So we were saying about the Nasdaq, I'm saying even the S&P, I think who thought we'll cross 5,000 on the S&P. The US markets are doing well despite dollar index about 205 and 10-year bond yield at 4.5. Now what is happening to Nifty? Nifty possibly is not giving a true picture. The broader markets is where the pain has started coming in and it's increasing with a rapid pace for the last few sessions. There is much weakness over there, and that is where we need to accept the fact that a large part of the money has come in, especially from people who are viewing this channel right now, the new investors who are coming to the market and are buying anything and everything. So loose money which was being made, or big money which was being made by buying across the board, that period possibly could be behind us. As far as Nifty goes, you see ITC, you see Marico, you see Britannia, you see even the IT stocks, which people were refusing to look at. They are showing a little bit of a bounce and protecting the Nifty, but the pain is elsewhere with the broader markets, which is more volatile. There is clear-cut exhaustion as far as the market goes, and some caution has definitely come in, largely to do with the elections. But if we look at the elections perspective also, the markets were going up because they were expecting this present government to come up with a big majority. Now, it was clearly noticeable, and I think I remember mentioning it maybe a month and a half when I was asked this question, that where is the hurry to buy? Because markets cannot go up for the same reason twice. Modi will come back to power. When he comes back to power, again the markets have to go up. Well, it doesn't happen in that way. So somewhere along the line, now money is rotating. Some of it is going into defensive sectors, the FMCG part, superb commentary by Marico, superb commentary by Britannia. So Lever also is going up, Nestle also is going up. So that is what is happening. Has some smart money come out of the market? Possibly yes. The other money is possibly rotating across sectors. Right now, FMCG is back in favor because there was not much of downside over there, though there is no great attraction to buy into them. So there I am addressing the answer which you wanted from me. There is no big reason to buy into FMCG. The point is you're not going to make big money. It is only that somewhere else in the market you are feeling a little bit concerned, a little bit worried. If one goes closely into the market, one realizes that everything that had gone up too sharply, obscene valuations, have come down sharply. But if you look at sectors like hotels, tourism, capital goods, they are still doing well. So where is the selling across the board? There are sectors which are doing well, the stocks are continuing to do well. So it is the expensive stocks, overvalued stocks, where there was just a lot of music running around them, people were just playing to the music, buying at every rise. Suddenly people are realizing that they were paying crazy valuations, and that part of the money is possibly coming out. So I would say the froth created by the new set of traders in the market, that is somewhere going off. As I said earlier, time for making money across the board could be behind us. Some smart money too could have gone out. But understand one thing very clear. This cooling off of the market possibly is very healthy. If earnings growth continues in 2024-25, if the monsoon is good, the same money is going to come back into the market. So I would say maybe 5-7% downside, possibly more from here, could provide a decent buying opportunity. So I am saying that there is no reason as such why the markets are coming down. Markets are definitely coming down because of caution, exhaustion, and somewhere on the line this caution is linked to what is going to happen on June 4th.
Absolutely, and maybe that cautious pause is, exactly what the doctor ordered, some could say. But, Merabun, you're talking about FMCG, and I guess this is just the stars aligning in a beautiful fashion for the universe market positioning, coupled with, of course, a lot of fundamental triggers that we've got over the last 48 hours or so. So let's straight away go across to Mangalam, because, of course, he's been sort of looking at this, the commentary, the numbers, and why is it that suddenly, after a long, long time, the market is latching onto FMCG stocks all over again? Mangalam.
Looks like the time for staples has come. It seems the stars are aligned is what you said. So it'll be 5 key reasons, business reasons why all these FMCG stocks are doing well. The first one, that there are green shoots in rural India. Rural accounts for nearly 35-40% of FMCG companies' revenues at large, and a large part of the FMCG volumes because of, low-priced products selling there. And there was a lot of pressure in the rural markets over the last couple of years or so because of unprecedented inflation. Now there are some green shoots. We heard from HUL first. They gave an inclination. Dabur was a lot more, definitive of 2x rural growth as against urban. Then Britannia pinned hopes on good monsoon, contained inflation for recovery. Thereafter, we got positive rural growth commentary coming in from Marico and Godrej Consumer as well. What all of this does is it gives companies confidence to go ahead and grow revenues in double digits. And there too, Dabur said this year they would grow 7 to 8% sort of volumes with double-digit revenue growth. Marico is gunning for double-digit revenue growth this year, along with Britannia saying that they too are gunning for growth in FY25 when it came to volumes. So those factors do well for the companies. With the revenues growing, will that have an impact on their margins? Will they have to compromise on the margins? Turns out not, because raw material prices are contained. At the same time, the companies have already increased or invested in ads, and now they're at comfortable levels without seeing much significant increase in ad spend. So revenues growing, margins staying stable, if not increasing, that does well for all the FMCG companies' EPSs. And importantly, the last couple of years also gave out some interesting trends which are sustaining in the next couple of years as well, or likely to sustain. Premiumization was one of them. For HUL, Marico, premium products grew at twice the rate of their overall growth. And for someone like Britannia as well, the new channels that they unlocked, which is e-commerce and modern trade, that too showed double-digit growth as against the company's overall growth of around 3% itself. And finally, we have, the companies who have taken some companies on board as acquisitions and gone on to distribution increasing spree as well. So we have Tata Consumer, which has acquired Ching's, etc. They will scale that up. Godrej has acquired Raymond's consumer business. That's scaled up as well. So those would be important fundamental reasons as well. All of this clubbed with the fact that the FMCG index has been an underperformer as compared to the overall market over the last 1 year or so. The FMCG index is just up 16%, with a lot of stocks actually being lower than what they were 12 months ago. That led to the big rally that we're seeing in these stocks.
Okay, thank you very much for that. In fact, let's also listen into some of the key commentary that we got from our earlier conversations with the management.
As a company, we have said our aspiration is to stay in terms of high single-digit volume growth. So we should be able to sustain that.
I believe that I think we are much better placed to deliver double-digit revenue growth next year.
We had spoken about that rural usually is always accretive to FMCG demand. And we had seen that was an area of overall business which had seen in macroeconomics, given the amount of cumulative inflation and the demand outlook, we've seen a purge of disposable income. And hence we've seen rural demand coming off. That we started to see gradual recovery as we had expected.
8% in rural and 4% in urban. So there's a 400 basis points of difference between rural now chugging better than what it used to be. Actually, after a span of 3 years that we've seen rural ahead of urban. And going forward, I think rural will drive the growth because urban is navigating a little bit of high basis of last year.
Okay, there you go. So that entire sort of slate of management commentary, which is all pointing to the same thing, that recovery perhaps lies ahead. Merabun, now we've already discussed the wider reasons why the market is moving to FMCG stocks, but now on the specifics, would you buy anything fresh on the staples side? Which stock would it be if yes?
Well, I would say this with that. Where is the hurry to buy? As far as FMCG goes, if you ask me, I think 4 of the stocks which you mentioned, which Mangalam mentioned, I'm personally owning it. I have not looked at the stock price for the last 2-3 years because they are a part of my core holding. So they are great companies to hold. Can I time as to when I buy into them? I heard the word that a sharp rally has happened. But if you look at the stocks 2 years ago and where are they today, there's hardly any impact. So yeah, that is where the money is going right now from people. The smart money which is going out of many other sectors, expensive stocks are going and sitting into FMCG because the management commentary has been good. Am I going to make big money from this? No, I'm going to possibly rotate it back into sectors and stocks as and when I feel the valuation is right, if and when we have a decent correction coming into the market. So if I'm worried of the market, but I don't want to pull my money out of the market, FMCG certainly is a decent sector to buy into. And over there, if you ask me, I think I'm quite impressed with Marico's commentary, followed by Godrej Consumer results, and also to some extent the Britannia commentary. So yes, I may go and park money into them. Personally, I'm not doing it. I'm holding 4 of the 7 stocks which were mentioned by Mangala. So I am not planning to add into anything right now because I feel cash is king at the moment. And whatever cash I'm holding, I'm going to deploy it as and when the market gives me an opportunity for a quick bounce as and when it happens. The time is not yet ripe.
All right, 4 out of 7. That's quite impressive, Mehrabun. Good on you. Your portfolio will be looking quite good, at least today. We have another set of numbers that's flashing for our viewers on the screen. Kajaria Ceramics. Out there's a revenue growth of close to 3%. But the EBITDA number has come down by 2.5%. It appears the street was expecting some kind of margin compression, which is up for you on the screen as well. Mehrabun, what's your view on some of these, building-related companies, Kajaria Ceramics and the other companies? This one has come out with a set of numbers. For the time being, the stock is up close to 1%. But what's your preference?
I would say that I'm going with real estate stocks straight.
Okay.
As far as NCDD companies, building NCDD companies, I think I would wait for some more time to come because the market has discovered the sector, money has gone into the sector, and somewhere along the line, I still have a small question mark in my mind, which may possibly get erased, about the spending which people are doing. So quite a few of these pipe companies, quite a few of these ceramic companies, I think somewhere I feel that they are not very attractive from putting in fresh money at the moment. So if one wants to buy into the property stock, they will continue to buy. I remain positive on them. They will also have a correction. But this is what I was saying, that if and when the market provides a decent correction, some of these property stocks should be attractive enough to put in fresh money. So even if one wants to put in fresh money, one can do it. So I would go with property stocks at number 1, something like maybe a Lodha or a Godrej Properties on a correction, something like that, and possibly look at this NCDD companies, ceramic companies, pipe companies a little later.
Okay. Mehrabun, what about something like Lupin? We've seen a sharp sell-off in Lupin. The numbers were not too bad. A little bit of a miss on the revenues. Revenue growth at 12% versus estimates of 14%, but margin sustained at 20%. But the stock is down more than 4%. Is it just that the stock has run up too much? It's up more than 100% in the last 1 year? Or is there something more? Is, the best over for Lupin?
A very consistent view for the last many years as far as pharma goes. I have been quite negative on pharma for many years. I turned a little bit positive last year, stating that there is not too much of downside, stating that with my contact with some of the pharma companies, that the worst possibly could be over as far as pricing goes, especially in global markets like the US and Europe. But that is not reason enough to go and buy into them. Now, when you look at the stock prices, look at the valuations, tell me where is the scope for upside? So you declare the numbers and you are going to fall, the stocks. So I think pharma as a sector from investment angle, there is not too much of opportunity to go and buy into them because simple, one line, most of the pharma stocks are richly valued. If you ask me, with the bare exception of something like an FDC or something like a Kaplan Point Laboratories, most of the other stocks, according to me, my personal view, they are quite expensive.
Okay, Mehrabun, we're speaking to you after a while. I hope we are able to speak to you regularly. Thank you very much for joining us, and it's a pleasure having you here on CNBC TV18. Well, 140 points lower is what you have on the Nifty, which is, not sharply lower as compared to when we started. And of course, it still remains quite a bit off the highs. 22,300 is around where we are at. We'll take a break here. We are back. We'll be joined by Amit Jeswani of Stallion Asset on the other side for a quick conversation on markets. Stay with us. Okay, welcome back. So things are a little quiet out here. 140 lower is what you have. 22,300, just under that level is where we find ourselves on the index. Amit Jeswani is now with us, founder and chief investment officer at Stallion Asset. Amit, good to have you with us here. Good afternoon. Thanks very much. We'll talk about the broader market, etc. But you're one who sort of shares what you've done in terms of your portfolio, etc. And we've always had a nice time talking about that stuff. So let's begin there. Amit, last time you were on, you were saying that your one sort of mantra is growth. The highest possible growth at the most reasonable valuations. So let me ask you. I believe you've added DOMS in your portfolio. That's one of the sort of latest additions. Talk to us about that. What are the prospects? Where are valuations? Go on.
So, Prashant, we've added DOMS. Good afternoon, Prashant. Thank you so much for having me on your show. Yes, we've added DOMS. We expect DOMS to do profits of 150, 155 crores in FY25. It's the market leader in stationery. So first of all, whatever I say, we have vested interest. Me, my clients, Stallion Asset is a PMS company. Me, my clients, my family, we all have vested interest in whatever I speak. This is just for education purposes. These are not recommendations at all. But yes, coming back to DOMS, yes, we've added that to our portfolio. We believe DOM should grow at 25% plus. It is reinvesting 100% of cash flows at 30% ROIC. See, in this industry, Hindustan Pencils is gone. Cocayo Camlin has gone, as in they've not been able to scale at all. Cocayo Camlin has not been able to scale at all. DOMS, on the other hand, has grown at 27% CAGR for the last 10 years. And they've consistently reinvested capital at 30-35% ROICs. And if you fundamentally think about it, there are very few companies in the country. Like DMart reinvests 100% capital at 22-23% ROICs. At 100% reinvestment rate is of Varun Beverages at 27% ROICs. Very few companies in this country can so we want the exceptional best quality. And when you have these kind of qualities, you have to pay up a little. And we've paid about 60 times, 65 times FY24, and about 50 times FY25 for DOMS in our portfolio. But I believe it's like a proxy FMCG bet. How many FMCG companies are growing at 25%? The only ones that are like Varun Beverages is one, but there is no other FMCG companies. When DMart would grow at 25%, DMart would get 100p. Now also it gets 100p, but when you get FMCG-like businesses that are growing at 25%, you get with high ROC. So you get high growth, which assures you decent returns, and you get low drawdown risk. You just don't want high returns. You also want very low drawdown. So that is how we have DOMS, and we've added DOMS to our portfolio.
Okay, all right. Amit, just hold on to that thought. There's some source-based information coming on DLF's launch of that Privana West in Gurugram. They have sold close to around 800 apartments of around 6.5 crores each, and the entire project is sold out. Wow, talk about demand out there, big demand out there. So the stock is still under pressure, but that's the big headline down there. That project that was launched a week or so ago, it's completely sold out. Well, Amit, good afternoon. Welcome to the show. But let's talk about Polycab. I believe that's one of your top holdings right now. Tell us, when did you add? Did you already have the stock in your portfolio prior to the entire income tax news that came out? And did you all double up your position, or was it a fresh entry post the fall? Tell us more.
So Nigel, good afternoon, Nigel. Nigel, first we bought Polycab by selling our Godrej properties at 1,200 rupees was Godrej property and 800, 900 was Polycab. This is about 3-4 years ago. That is where we added. We sold Godrej properties at 1,200 and 900 we bought Polycab. We were holding on to Polycab till it was at 5,500, and when that news came, we sold. We had 8% weight through the portfolio. When that news flashed, risk management first, we sold till at 5,300, 5,000, like those levels. We got it down to 4%. When the news came out, the stock, when PIB letter came, the stock was at 3,800. We didn't touch because we were too scared. But when the results came out, the day the results came out, and KPMG, the auditor, BSR & Co. gave a green signal that there is no problem in Polycab's book. And you were getting Polycab at unbelievably reasonable prices. So we believe the risk reward was in our favor at 4410. We made it from 3% because when the stock goes down, your weights go down. From 3%, we made it back to 8%. And since then, we are riding. Hopefully, now KEI has come out with numbers. The growth of KEI is 19%, and KEI is trading at 60p. RR Kabil should do 300 crores of profit, and market cap is 18,000 crores for RR Kabil. Last quarter, RR Kabil did 11% growth. So 60p is where RR Kabil is. Now, my base case estimates for Polycab is 1,800 crores PAT, and my best case is about 1,850 crores PAT. So basically, if that happens, Polycab right now is at 88,000 crores market cap. That means Polycab is at 48 times. And being a market leader, and it should grow at 25-30% plus. It should be the fastest growing guy. So no reason why this discount should be except for that income tax problem. Yes, so let's see. I don't think this discount will last for a very long time. If the results are 25-30% growth, the stock should move even higher towards 7,000.
Amit, hi, good afternoon. I recall our last conversation very well, and the underlying sort of thought process was that you want to go for growth. And you're not going to compromise on that. You're going to go for sector leaders and the ones that are, growing the most. So just for the benefit of our viewers, I mean, some of those holdings, at least you had, up until early April, there was Trent, there was Policy Bazaar, Zomato, stocks like Angel One, MCX, Nuvama, and many of them, in fact, most of them have done exceedingly well. Now my question, given the current market setup and this jitters on election, volatility, mid caps are cooling off a little bit, are you taking profits anywhere? Or are you just happy to add in this portfolio that otherwise has been red hot, running super strong?
So we've cut some Angel in our portfolio. We were getting a Lamborghini. We had to settle for a Mercedes in Angel, but Angel we've cut about 70% of our allocations, 80% because of the QIP, IPL, and somewhat little slower growth. So we were making more money. We were getting a Lamborghini, but we had to sell to a Mercedes and still be happy.
Okay, just hold on. We'll come back. There are more questions on the Mercedes, the Lamborghinis and everything else that you're driving. But before that, we've got Mangalam standing by. Titagarh Rail has been surging in trade on the back of a Morgan Stanley note. So let's just quickly dive in and take a look at that stock as well. Mangalam, what are you picking up?
Well, Titagarh Wagons has already seen a big rally over the last couple of years, but Morgan Stanley believes that there is some more as well. They've initiated coverage with an overweight rating. The target price that they have is a whopping 1,285 rupees. They see strong evidence of revival in India's railways, as well as believe that Titagarh is a large beneficiary of that. In fact, they view their freight business as a cash cow for the company and passenger business as a new growth engine. The management multiple times have told us as well, while their order book is 50-50 freight passenger, currently the revenue that they get is 90% from freight and 10% passenger. So this becomes a growth engine for them, pun unintended. They forecast, Morgan Stanley, that is a 28% earnings CAGR over the next 3 years. And the freight wagon execution of 1,000 per month will in will be between 1,000 per month between FY25 and FY27 as against 800 that they saw in FY24 itself. And passenger coach execution will be 26, 76 and 96 coaches per quarter in FY25, FY26, FY27. So all these factors doing well for Titagarh Rail. That stock up 4% as well.
Amit, does railway catch your fancy, and in that particularly Titagarh?
No, so I don't have any railway stocks in our portfolio, unfortunately, because they've made a lot of money, but it's okay, like we've missed out the entire B2G rally. We have no exposure towards B2G, as in it's near zero. So that's why we don't have to even care so much about elections. We are chilling.
All right. But you made a lot of money, I presume, in NetWeb, because the issue price was about 500 rupees. The stock is now closer to 2,000 rupees. At what point did you enter, and what's the story behind NetWeb?
No, NetWeb we just entered like a few days back. So we entered after the results. We've entered NetWeb. So we are yet to make a lot of money, but hopefully we will. NetWeb, again, it's into supercomputers. If you see NVIDIA is still at $900 plus $920. See, there's a very large growth which will come in. It's expected. This is the only industry in India which is growing at 35-40%, and you need a player who can execute right. These are a little riskier bets. This is tailwind investing. And my understanding of tailwind investing is that if you get a large tailwind and a good executor, you end up making a lot of money. NetWeb does ROCs of 38% last year. Their total revenues last year was 700 crores. Their order book, which they have right now for the next quarter, because their order book gets completed in like 2 weeks to 3 months, is 400 crores. And their L1 is one more around 300 something crores. Basically, your entire FY24 revenues should be done in the first half itself. And when you have such kind of hyperscaling, such a large opportunity in data centers, in supercomputers and AI related things. So yeah, we've given it a try. We like what Lodha is building. We have done a lot of background work on it, and a lot of people are saying good things about like whoever we speak to, from the data center guys, from Anand Raj, etc. Whoever's in business, they all use NetWeb products, and this trend there. Last year also the growth was 70%. So these are not very large locations. These are smaller locations where if you go right, you end up making a lot of money. If you go wrong, you lose 20-30%, and just say that it was bad strategy and you'll move ahead.
Amit, so they are into server. They make servers.
Yeah, so they import from AMD. They are like partners with AMD, Intel, and Nvidia, and they're like golden partners. So they have all decent access. Like for Nvidia, they're there since 2010, and so there are quality of partners. You have gold, silver, platinum, etc., and they're one of the highest partners for these kind of companies. Even from your Graviton to your IITs, Graviton is that algo trading company you see in block deals every day. They are their clients. So a lot of high-tech clients are there. They've got super clients. They've added 175 clients this quarter. So if anyone's looking at these are very early stage investments. Their profits are only 70 crores, but the size of opportunity is so large. The numbers are just one company who's doing a Yota, who's doing a 16,000 crore data center capex. So there are multiple such companies. Like Anand Raj is doing very large capexes, and there are so many unlisted companies. So and our feedback has been very strong, and we're waiting for numbers to make decisions. So yeah, we've just added. I hope we make money, but even if we don't make money, it's okay.
You've also fair enough. That's NetWeb. In real estate, I believe, Amit, have you added something?
So we've cut down beta of our. So we cut capital markets a little bit. Our allocation in capital markets 9%. We cut lenders a little bit. So we have to. So whenever we bet, I add beta to our portfolio. We have to cut beta from our portfolio. So our since inception portfolio beta has been 0.77 against Nifty 50. So we are very conscious on that. So for real estate, we've added 2 best real estate companies in India. One has grown at 90% plus. The group got family settlement just done. The growth was 90% on Godrej. I'm speaking about. These are not recommendations, of course. So we've added stocks like Godrej. We've added stocks like Prestige. These are the best quality builders doing 20,000 plus crores of sales, scaling at unreal rates. Like and the guidance are also very strong. So Godrej trades between 2.5 times pre-sales to 9 times pre-sales. Right now, at 27,000 crores guidance, if you do 2.5, 3 times, you're on the lower end of the guidance. So basically, even if Godrej goes to 20, like 3 times, 3.5, 4 times, 5 times, you should double your money. Very decent tailwind. See, this is the biggest tailwind. This is the biggest tailwind that I'm seeing in real estate after multiple years. And it's not just so the total listed builders, the top 15 listed builders, did about 63,000, 64,000 crores of pre-sales last year. This year, those pre-sales are up 50-60%. There is clear market share gain which is happening by these builders. Most of these stocks are making new highs. We are also trying. It's only 3% of our portfolio, both stocks combined. But we are also trying. See, you have to find new trends, and because the old trends you've already made so much money. I will go wrong in some of them, may lose 20%, but if I go right, I'll make 200-300%. That's the whole idea.
Okay. All right, Amit. Great conversation as always. Thank you for joining in. Looking forward to the next one already. You have a good afternoon. Let's quickly Thank you. Let's quickly take a break. With the news, the market is trying to find its feet. I mean, the Nifty is still nursing a cut, but it's about 150-point cut, so off the lowest levels of the day. We'll come back on the other side, get you a check on what's happening in dealing rooms, and of course, some final trading calls coming up with Mitesh as well.
Welcome back. You're tuned into Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, it's that part of the day when Nimesh joins us to tell us what's he picking up in terms of D-Street chatter. Well, Nimesh, we have it happen, right? The markets are opening up in the green, but unable to sustain at high levels. What is the feedback that you have?
Well, the market actually are off the day's low. Yeah. There is a bit of an attempt for a recovery as well. But I guess, the selling pressure continues for the second day running. So there is selling across the board. So, every sector is under pressure. Metal, the PSU stocks, metal names, real estate stocks, even the pharma names are under pressure today. The mid-cap index is down another 2%. So looks like there is a bit of profit booking and a bit of unwinding as well across the board. But I guess clearly the sector of the day is FMCG. That index is up 2%, big movers in that particular sector, and that's largely on the back of strong commentary from the managements, right? But there is a technical factor as well, is what I understand for today's pullback. There is a long-only wealth fund in the India portfolio was short consumer and long financials, and that got reversed today. So they had to buy into the consumer names and sell the financial stock. So I guess that also explains a bit of sharp move in the FMCG stocks today vis-a-vis the financial names. So that's a technical reason for the move today. But I guess given the election jitters, given that the earnings are so much all over the place and been volatile as well, it looks like the volatility is likely to continue. But again, the PCR has fallen to the comfort zone of 0.75, 0.76. So watch out for that. But I guess there are technical factors. Markets are under pressure. But I guess from a flow perspective, there is a bit of selective buying again in the IT names.
Well, I think the sectors that are outperforming came in for selling. Yes. PSUs, you have metals as well as pharma. Correct. And the one that people were underweight on, the FMCG index, that's done very, very well. But tell us more, Nimesh, what are the stocks you're tracking?
Sure. In terms of individual names, the first stock on my list is Mankind Pharma. That's been consolidating of late, but now I understand there's going to be a large block deal very soon, a potential clean-out trade from a private equity investor, so watch out for that. The second name is Alchem Labs. While the stock is marginally under pressure today, but off late there is a bit of buying interest back. I understand a leading PMS fund is an active buyer as well in Alchem Labs at these levels. The third is SBI. While the banking sector is under pressure today, SBI is relatively holding up largely on back of buying interest. So I understand a leading long-only fund is an active buyer in SBI, and there are buy flows today as well in that particular name. And the last one is Infosys and Yes Bank. I've picked up both these names largely on back of strong buy flows. So expect high delivery volumes. While Infosys has recovered intraday, Yes Bank is still under pressure, but there is very high delivery-based buying in both these names in today's trade.
All right, Nimesh, thanks very much for that. So those are individual names which we will sort of look to track as we go on. SRF numbers are at the bottom of the screen. Just a quick look. Profit number was flashing. Revenues are 3570 crores. These are slightly above what the expectation was, which is about 3530 crores or so in line. EBITDA, I think, though, is slightly lower. So it's coming at about 696 crores, and the poll suggested about 770 crores. Margins are also lower to about 19.5% as compared to a poll of nearly 22%. Stock was down, I guess, in anticipation of the numbers. So there's no fresh big reaction or anything. It was down, I think, from the word go. It's been slowly coming off. So we'll sort of have more with Sonal on these numbers as we go along. Mitesh is with us with quick sort of short-term trading ideas. Mitesh, what do you have?
So I think, Prashant, I'm looking at some safety, and the one underperforming sector which is doing well is FMCG. The other one is IT. So TCS is a BTST for me. I would take a stop around 39.60 for targets of 4,010.15 for tomorrow. And Tech Mahindra, disclaimer that it's a recommendation to our clients. There's some vested interest. Tech Mahindra is a BTST with a stop at about 12.80 for targets of 13.05.
Okay. Thank you very much for that. Let's quickly get to, let's get you up to speed in terms of the big earnings that are expected today. So first up is Dr. Reddy's. Ekta joins in with the expectations. Ekta.
Thanks for that. Well, for Dr. Reddy's this quarter, it is expected to grow around 17% in terms of revenue. So overall, a strong quarter. Margins of around 28%. Now, in terms of the key driver for Dr. Reddy's this quarter, it is expected to be the US business. So the US business is going to be driven by Revlimid generic. The estimates are that it will contribute over $100 million this quarter, similar to last quarter, and maybe a few million higher. So 110 odd is the upper end of the range for Revlimid generic in terms of contribution. Overall, besides that, the US base business performance in terms of key drugs will be watched out for, and the estimated sales for the US business as a whole, including Revlimid, can go up to around $412 million for the quarter. Separately, India is expected to grow around 8 to 10 odd %. And there will be commentary with regards to the Russia business, which will be watched out for, considering the geopolitical situation there. So up around 10 to 11 odd % is what the street is anticipating. Margins should be strong, led by the US business, anywhere between 27 to 28%. Commentary with regards to the Revlimid generic litigation, the overall US business price pressure will be watched out for.
Thank you very much for that. Let's quickly talk about UBL, United Breweries, and what the street is anticipating this time. Mangalam is here.
Well, a good tipple is what the street is working with this time around. Why do I say that? Because we already have a cheat sheet coming in from their parent Heineken, which said that the India beer volumes grew in low teens, and that's much higher than what the street was anticipating going into numbers itself. The premium portfolio for UBL grew in low 20s, and it was led by Kingfisher Ultra as well as Heineken Silver. Revenue excise for the company should grow around 12.5%. 1986 crores is what we're looking at, with EBITDA growth on a much smaller base, up nearly 3 times. We're looking at 190 crores. This compares with just about 53 crores that the company posted same time last quarter. Margins closer to double digits, much lower than their historic levels of low teens, but then again a significant improvement from the earlier pressure that these companies have been facing. 114 crore on the bottom line. That implies that 10 to 12% is what the street is factoring in terms of volumes, but the company already has reported low teens volumes as per Heineken. Base quarter was actually impacted by the change in operating model in both Tamil Nadu as well as Andhra Pradesh. So as a result of which, we are seeing the numbers looking a lot better. And 4 to 5% change in realization is what is expected due to premiumization and price hikes. What we'll keep an eye out on, more importantly, are gross margins, which are likely to improve by 600 to 700 basis points because of lower barley and lower glass bottle prices.
Okay, thank you very much for that. Get into a break. On the other side, Jay Bala from cashthechaos.com will join in. Stay tuned.
Welcome back. Well, Jay Bal of Cash the Chaos joins us on the show. Hi, Jay. Good afternoon. Tell us your view on the Nifty and particularly with focus on Reliance Industries, which of late has been doing a bit of an underperformance.
Hi, Nigel. It's a very important data point to note. Reliance has, for the first time in several months, is clocking lower top and lower lows. And it's gone below 28, 25. So that's an important price pattern, and the fact that it's occurring after a long time and on the day when Nifty is negative is adding a little bit of significance. And also, Adani Enterprises today is breaking down from a head and shoulders pattern. So my question to the market is it sending some political signal?
Okay. Hi, Jay. Good afternoon. Good to have you on. Overall, the market's been struggling for a while, right? I mean, last couple of days, it's not, I mean, the fall is about, if you look at it, the Nifty is, I think, 2.5% only off from the highs. Mid-cap index maybe 3% or so. But the underperformance is quite stark. The fact that the market can't hold the day's high, the distribution, the sell-off in the broader markets, all these things we can't ignore. So what are the next levels that you'll be tracking on the indices, Nifty or Bank Nifty?
Yeah, my question should be, this market has been doing this for quite some time. In fact, from the beginning of 2024, each time it pushes to a record high, it's unsustainable and the market gets rejected into the previous range. And the next critical support for Nifty comes at about 21,770 to 21,710. If that were to get taken out, I think the markets would be in for a medium-term correction that corrects the market's move at least from the October 2023 low, if not slightly bigger. So watch 21,770, 21,710 like a hawk. And I don't think we need to talk about resistance because this markets are struggling with each new high. But as long as 21,770 and 21,710, that range holds, the market won't be getting into trouble. But below that, trouble starts.
Do stay on. We just want to quickly talk about SRF and more details about the numbers. Sonal, looks like a miss.
It is a miss, especially on the margin front. So margins have come in at 19.5% versus an estimate of 21.9%. However, there is a recovery across businesses when it comes on quarter-on-quarter basis. So if you look at the numbers in their technical textiles business, it's a recovery of 1%. Chemicals business has seen the biggest recovery in their EBIT, that is 55% on a quarter-on-quarter basis. However, packaging business continues to be under pressure. That one is down 25%. The management did indicate in its commentary, they say that the operating profit of the chemicals business declined on a YOY basis. This is because the chemicals business faced headwinds due to inventory rationalization by key certain customers and also because of Chinese dumping. So that continues to be a problem area for the chemicals business. They say a lot of capacity has come up in China, leading to pricing pressure on intermediate products. In addition to that, the management says that while the general performance has been weak, they have seen reasonable recovery in chemicals business and they believe that recovery will pick up from second half of FY25. So that's some positive commentary coming in that they believe recovery has come by and it could continue in FY25 as well. And they also say packaging business will see some improvement, which has not been the case for a while now. So commentary is positive, but the numbers are a miss.
Okay, but the stock is still down close to about 7%, so not reacting to the hope built in the commentary about a recovery in the second half. But Jay, getting back to you and wanted your thoughts in on FMCG. Do you think the FMCG sector can assume leadership? Any stocks that you like?
Yeah, FMCG, I think I pointed out last week, I'm not sure if it's for you or it's another business channel. I had anticipated a counter trend bounce, but it looks like FMCG might even have the potential to scale the record highs past 58,000. But it's the laggards, relative laggards, I should say, that's been trying to take the leadership. Godrej Consumer could be the one that's leading the way. HUL has a sizable counter trend rally, I pointed out last time, and that's actually could contribute to the index. And the laggards that I spoke about, Dabur and Marico, they could be contributing to the index move, but something like ITC, Britannia, and Nestle, they could be taking a laid-back move. But these names that I mentioned, they could be contributing to the potential move to record highs for FMCG index.
Jay, real estate you think is looking a little toppish?
Yeah, this is an important sector that we should be taking note, Prashant. I've been bullish on the real estate sector from the middle of 2023, and DLF I've been most bullish, and that's been the leader. And DLF looks like it's topping out of and coming out of a head and shoulders top. And I would like to see the Nifty real estate index break below 910 to conclude that the reversal has taken place, because this is a strong performing index, and we don't want to be early and be caught on the wrong side. If 910 on the Nifty reality index were to get taken out, I think it will be a convincing reversal for the sector. And DLF is already signaling that that might be possible.
Okay, so given that we're in the midst of all of these cues, let's wind it up, Jay, with then some trading advice, specific calls that you can leave us with.
Yeah, I'm negative on the banking space. The private sector banks looks more vulnerable than the PSU banks. PSU banks could have little more higher highs to come through, but it's not conclusive. If the reason why I'm negative on private sector banks is because the private sector banks have the Nifty private sector index has clocked a lower top to its Jan 2024 low, and if it were to drop below 23,500, 23,000, that will mark a reversal for the Nifty private sector index. So I have a short on RBL Bank. This has been one of the laggards within the space. The structure could have been a little more perfect. I would have liked it to rise to about 280 and then come down, but it seems to be in a hurry going down. So a stop about 273. I think it got potential to drop to about 210. The other one is from the PSU banking space, Bank of Baroda. Bank of Baroda looks like it's clocking a double top, and it has potential to drop to 220. So stop above the recent high of 285 makes sense, but you need to be a little more measured here. So it's the weakest within the PSU space.
Okay, all right. Ajay, got that. Thank you very much for your time. I mean, we could not touch upon the global picture, which we hope to do with you in the next interaction. Appreciate it. Thanks very much. So that's the market closing 140 points lower. So exactly at about 22,300 is where we are going to end, which is basically just under the 40-day. The 40-day as of yesterday's close was 22,311, and we're at 22,300. So yesterday we broke the 20-day by just a bit. Today we've broken the 40. So slowly but steadily, you're getting a bit of a pullback here. Just a quick look at the large cap. So Bajaj is the big loser. Nifty stocks. Power Grid is the other one. ONGC, Hindalco, and IndusInd Bank are some of the others, which saw some cuts come through. So that's the pack. Mid caps and small caps, by the way, between 1.7, 1.9% cut, so much larger as compared to what you saw on the Nifty or the large caps today. Okay.
Well, there was a clear defensive tilt to the markets today. So on the way up, the Nifty FMCG index saw day two of buying and good buying. The Nifty FMCG index was up close to about 2%, with HUL leading the charge 5.5%, Britannia, Nestle, ITC all gaining close to about 1.5 to 2%. The other sector which was higher today, ending with gains, was IT. The Nifty IT index up 0.7%. Tech Mahindra TCS led the charge there.
Very quickly, talking about the broader market sell-off, 2% down on the mid-cap index, and large stocks have fallen today. Some of them, of course, are PSU. We've been pointing that out. The PSU rally is sputtering. So, your Aircon, NHPC, SJVN, Central Bank of India, SAIL, all of these stocks falling with a fair amount of volume as well. But beyond the PSUs, I mean, look at stocks like SRF, Torrent Power, Prestige Estates, something like an Inox Wind, quite a few of these names, SEAT, Root Mobile, Just Dial. These are big stocks and pretty widely tracked, well owned, and the cuts were between 5, 6, 7%, depending on which one you were looking at. Of course, the real estate was one of the weakest links, as we've been pointing out. Sobha down another 6%, and a couple of other lenders also on the lower side of the screen today. So all in all, ending with the Nifty just around the 22,300 mark. Okay, well, with that, it's a wrap on this edition of Closing Bell, but don't go anywhere because we continue with all the market action. Up next is Markets Forward.